Alrighty, I'm going to be introducing Miss Samira Hussein, who is a professor of business administration here at Johnson County Community College. She teaches several business courses, and I'm fairly certain that she has taught every single one of our currently offered business courses. And this is in addition to developing new courses for us, specifically in the field of international business. She has authored several international business courses, and many of them are actually going to be integrated, I believe, is it next semester? I think it's going to be integrated in the spring. She's traveled extensively and has taught classes in several countries, including China, Pakistan, the UAE, and of course, yours truly in the USA. In the past, she has worked on partnering Islamic studies and China studies through Title VI grants, or is it Title IX? No, 6. Title VI grants from the State Department to alter modules in her courses to include this. She was also selected as a group of Fulbright studies to Morocco. In the past, she has worked with the Institute of Business Administration in Sukkur, Pakistan. And following this, IBA, the Institute of Business Administration in Sukkur, was awarded a U.S. Embassy grant, which led to exchanges of IBA faculty and JCCC faculty. She is a past recipient of the Burlington Northern Teaching Award, a Distinguished Service Award, and ACBSP's Teaching Excellent Award at JCCC. All of these lovely acronyms are, of course, the business ones, the partnerships we have outside there as well. Currently, her interest is in integrating and incorporating artificial intelligence into every single one of her courses, which I believe you fully integrated this past semester. That was how she spent her summers. So she's a tireless fellow here at Johnson County Community College, and I can tell you from personal experience that our business department would not function without her. So give it up for Miss Samira Hussein.
Thank you. Thank you for that kind introduction, and honestly, I am flattered to be selected as the college scholar. I just recently celebrated 30 years, as some of my colleagues know, and this has been an ardent desire to present something. And in the past, I also teach a course in women and gender studies in psychology, so I had thought about presenting there, and then, of course, other topics came to mind. But this combines my dual background in clinical psych and also business administration, so I'm flattered that I get to combine my two loves here. As the topic shows, that there are going to be, what I hope to present today is that we think of financial markets as perfectly running mechanisms that do not have any room for biases or emotions as such. But what I'm going to provide to you as an alternate is that there are indeed human biases that are being corrected through the use of AI, but nonetheless they remain on a repetitive cycle. So with that said, what I would like to do first is to give you the difference between what traditional models tell us how financial markets work, contrast that with the behavioral finance model. I also want to then jump into some anomalies that we see, which is the heart of this presentation. And not only do assets and markets get affected by our biases, but I also want to show you how our personal 401k portfolios that we think are diversified are not exactly free from those biases either. And lastly, of course, I don't think anything we can talk about without the role of AI and how AI is mitigating all these fields. So with that said, let's go ahead and get into what is behavioral finance. Behavioral finance is a relatively new field, mostly attributed to Daniel Kahneman, Amos Tversky, and Richard Thaler. Amos Tversky and Daniel Kahneman, both psychologists, were instrumental in coming up with what is known as prospect theory. prospect theory, the essence there is that how investors make decisions under risk, not how they should, but how they actually do. And the essence there is that there is a greater amount of loss aversion versus gains. And I'll get into all of that in a minute. But they certainly challenge the whole notion of Homo economicus, that we are rational beings. We end up making decisions based on data, on rational expectations, if you will, whereas what they are saying is that we are emotionally driven. We have our own cognitive biases through which we examine these decisions, especially in the financial markets. And interestingly, I don't know if this would make some sense for you, but as a psychologist, Kahneman and Tversky, Tversky died before the Nobel Prize was awarded, but Kahneman, a trained psychologist, actually got the Nobel Prize in economics. So that tells you how much of an influence Kahneman had in the field of economics that he actually got. I believe Tversky would have gotten it, but Nobel Prize is not given posthumously. Anyhow, so I want to get into three aspects of traditional markets, and based on those, I then want to contrast that with the behavioral finance study. The first thing I want to explain to you is how traditionally investors, institutional investors, retail investors like you and me, how we see the markets. The first explanation that we see is the efficient market hypothesis. The efficient market hypothesis is simply telling us that markets work smoothly because there's no room for price fluctuations because that will be quickly arbitraged away. What does that mean? Arbitrage simply means you buy and sell something within simultaneously. So to give you an example, let's say that Apple was trading at $218 on the London Stock Exchange, and it is trading at $220 on NASDAQ. Then institutional investors especially will arbitrage that within seconds. And so the efficient market hypothesis says markets do not allow that type of arbitrage because there is so much of data, and all available information is instantly priced into the security. Rational expectation theory says that, again, markets are based on our rational expectations. So if Jerome Powell says that, hey, the interest rates are not going to be lowered for the fourth time, they've already been lowered the third time, then institutional investors and retail investors like you and me, we will think in terms of what the bonds will do, what the stocks will do, the ones that are especially sensitive to interest rates. And so we project that into the future. It's like knowing that there's a citrus frost in Florida. What do we expect the orange juice price to do? That's a rational expectation. And that is also priced into the existing securities. The random walk theory says markets are efficient because past movements are no predictors of future movements. It's like me trying to stand in front of a drunk and seeing which direction he will go. I have no idea. At the end of the day, random walk theory says that existing securities do follow a normal distribution pattern, and what that does is it sort of removes all that speculation that happens due to technical analysis. I tell my students not to really dabble too much into technical analysis as much as fundamental analysis. Next, I want to get into how assets are exactly priced in their traditional models, especially by these financial analysts. The capital asset pricing model is one of the most common ones. Here, the financial analysts say, what they do is they will look at, let's say, again, Apple, and they say that how volatile is that Apple stock? 1.2, that's considered the beta. And with that, they then compare it to something that is risk-free. For instance, the treasury yields. If the treasury yield is giving you 4.2, And the market premium for the entire market is 10%. Without going into the actual math, I can tell you that the capital asset pricing model will tell me that Apple should give me 11.2%. What that means is that 11.2%, if an investor is getting an expected return out of Apple greater than 11.2, then the investor will go for it. If it's less than 11.2, the investor says, wait a minute, this is an overpriced stock, I'm staying away or I'll short it. The next is arbitrage pricing theory, which is again talking about how rationally the markets work. Because what they are saying is that instead of just talking about the premium from the market itself, let's take a look at all other factors, the GDP, interest rates, a number of host of economic factors, and base our asset pricing on all of those macro factors rather than just the market premium. And this is how exactly price discovery takes place in institutions, because they consider entire macro factors. Next is the modern portfolio theory, and here, Harry Markowitz in 1952, he came up with the notion that, look, assets are not priced on the individual attributes, but rather the correlation of all these assets on how they maximize the portfolio return. So for any investor, what they are trying to do is maximizing their returns for a given level of risk. So when institutional investors or retail investors try and think about adding securities or getting rid of securities, they're looking at the optimization of the entire portfolio rather than individual assets. Next, I want to talk about the investment strategies in terms of how investment takes place through quantitative finance and algorithmic trading. This is actually starting to become more and more popular. And in a minute, when I talk about AI and its influence, you will see how algorithmic trading has taken off. Here, there are companies like Renaissance Technology and Six Sigma that basically are doing trades in like milliseconds. No chance of any kind of arbitrage, and basically they would probably find it humorous that behavioral finance has any effect on their trades. And lastly, if you're looking in terms of broader investment strategies, then we are looking at fundamental analysis, which the only name that comes to mind is Warren Buffett, who says, hey, an investor would not buy a car. An investor wouldn't buy a car without looking at the mileage, without looking at whether it is a clean title or not a clean title, what kind of year, model, and make it is, and then come up with an intrinsic value for that car. Similarly, an investor would not, whether institutional or retail, would not go for the stock if the fundamental analysis showed me if it was an undervalued or overvalued stock, if you will. So far you're thinking, well, she's making a pretty good case about how markets are working rationally, so why am I here then? I thought the topic was anomalies due to behavioral finance. Well, I'm about to get into it. And when you examine the different types of anomalies that are mentioned in the literature, they may have different ways of classifying it. I've classified it into three categories: cognition-based, emotional-based, and calendar-based. Believe it or not, there are calendar-based anomalies. So under the cognition, you have three different categories: anchoring, representativeness, and availability. And what that means is, I'm going to give you examples in here in a minute, that investors can either anchor a price of a certain security and base it off of that, or they can go ahead and think, well, if this is a technical company and I'm about to invest in a technical company, then it is representative of that entire industry. I'm going to make a killing. And then lastly, availability heuristic is what comes to mind recently. So cognitive bias, anchoring bias, I can give you several examples on how that works. So as soon as companies release their earnings, what happens is that there is what is known as a post-earnings announcement drift. It's called PEAD in the financial literature. What PEAD does is it keeps that momentum going, even though it has been factored in and it has been already priced into the securities. It lasts for months, sometimes for weeks, sometimes just for a day. But PEAD does happen. So earlier, I was telling you that arbitrage is not possible and pricing is instantaneous, but yet PEAD is a very well-documented phenomena. Netflix stock dropped 8% in 2024 after reporting missed subscriber growth. Now, you and I all know that Netflix is in, 170 countries. They will do well. But as soon as they miss that earnings spot, subscribers or investors rather, they are quick to respond and psychologically will react to that particular news. NVIDIA stock jumped 10% in May 2024, and then it climbed 25% after the PEAD, and it continued to climb for several weeks. So, and Tesla, the same thing. Investors are not looking at the fundamentals. They go with that momentum and keep going. Representative bias, I think it's safe to say that it was well documented in the dot-com bubble when investors thought, well, Amazon and eBay are dot-com, so if I invest in pet.com, I'm going to be fine. It was so surprising that Pets.com, a company that had operational issues, I mean, imagine you are on the verge of, during that dot-com era, and you're shipping heavy pet food with high shipping costs. They didn't think their operational costs through. They floated their stock in, I want to say, February 2000. By November 2000, the company was done, finished. So what that tells me is that investors had rushed in to Pets.com simply because of representative bias, that it's a dot-com company, I'm going to be fine. I'm glad I was not an investor. Complete fundamentals were ignored. There were good signs that they were not going to make it with those high operational costs. Cognitive bias, availability heuristic. I'll tell you, here, as soon as an incident comes in mind, the investor starts to react. In 2018, Southwest had an accident. One person died. All of a sudden, the safest industry in transportation got affected. Of course, they lost money, over $100 million. Toyota last year recalled in 2024 some of their models based on the brakes failing. Again, these are temporary glitches that happen in any industry, but investors are quick to react because that's what comes into mind, availability heuristic, that, oh, if this has happened, then I better get out and jump. A knee-jerk reaction that takes place, it's, again, very well documented. Next, I want to talk about the emotional-driven anomalies that you see. The loss aversion, which is exactly what Kahneman and Tversky were talking about, that people, investors rather, I should say, react differently to losses than to gains. So if I lose $100, I feel the pain a lot more than when I gain the $100. And that's an interesting psychological phenomena. Overconfidence leads to excessive trading, and people do that. In terms of overconfidence, we also see that trading volume spikes, and it creates that entire cycle based on which you start to see overvaluation because people are so emotionally invested in those particular securities. And mood effects are well documented in terms of what happens to stocks on Monday morning, what happens to stocks in January, and I'll talk about that. When some negative news is released over the weekend, what happens is that that investors are pessimistic. On Mondays, you will find that stocks are being sold, and even institutional investors, they have a lag, which is then affecting the retail investors as well. So emotionally, when we are talking about loss aversion, here's a good example. That in 2008, when the financial crisis took place because of subprime lending, what happened was that quickly Bank of America, as an example, rebounded. It was a wonderful stock. It was trading at book value, but investors said, no, not touching that. Because why? Why? Because it reminds them, again, of that representative heuristic that I was talking about. If it's part of the financial industry, I'm staying away. So instead, investors went towards the growth stocks, Amazon and Google, and those were considered safe bets. What that did is that created overvaluation there, and instead, they would have been better off investing in a value stock like Bank of America, which was trading at book value. Another emotional bias that I have, that literature tells us, and I've seen, and I personally, honestly, I feel like I do it myself sometimes, disposition effect. That if I buy a stock because of my loss aversion, that is what Kahneman was talking about, I will hold on to the losers too long, because what am I hoping for? I'm hoping that the stock will come back. And it has nothing to do with the fundamentals. It has everything to do with the fact that I could not have made such a bad decision. And so anecdotal evidence of something like this, my own brother, he's a mechanical engineer, was well aware of the Enron and the energy sector and invested in it. And I want to say he bought it for $30, saw the stock climb up to 90 plus. And of course, I was starting to get into investments and teaching investments, and I told him, hey, brother, I think Enron is issuing a lot of junk bonds, 12%, 13%. That's a clear signal that they are in trouble. And I think you should start thinking about selling your Enron stocks. Well, what does the little sister know? So he hung on to it, hoping that those declines would come back. In the end, 7 cents per stock is what he ended up. And there was no point at that moment in trading it even. So the classic example is, and this still happens, that people start to get emotionally invested. Tesla momentum and overconfidence. How could Elon Musk go wrong? How could an electric vehicle industry that is nascent, that is just coming in, and that has got all of the bells and whistles of the clean energy go wrong? So we went from $200 to $900. Again, emotional investment. So I found it fascinating that this particular financial analyst is not just talking about how stocks are traded on sentiment, but also specifically how Tesla really was part of that emotional momentum, if you will. So anyhow, this particular video, the analyst is talking about a study done at University of Arizona, or ASU actually, the Carey School of Business, that one of the financial professors actually tracked 26,000 companies from 1929 all the way to 2023. Of the 26,000 companies, guess how many actually were giving a positive return, or actually returned half of the gains made in the in the stock market, which was about $16 trillion. How many companies out of 26,000? Any guesses? 0? Oh, that's too conservative. I wish I had those companies, but nonetheless, any other guesses? 25? 86 companies out of 26,000. 86 companies gave a positive return, and you wish you had had it in terms of your portfolio. So basically, again, this is part of why do investors then go for those 26,000 companies? How do they know that those companies are going to give them any kind of decent returns? Well, they don't. And so the calendar-based anomalies actually are also documented, which has to do with the psychology of investors. What you will find is, as I mentioned earlier, Monday returns are usually negative, Friday returns are positive. And again, the bad news has a little bit of a lag time for investors. And this is also reinforced by what institutional investors do, as an example. And it completely contradicts the efficient market hypothesis, which says all pricing is instantaneous and it gets factored in. It has nothing to do with that actual real-time pricing, if you will. Calendar-based and structural anomalies are also well documented on the January effect. Here, what you and I do, and we do it subconsciously or consciously, we put what is known as in behavioral finance is mental accounting. So when it comes to my money, I say, okay, this is my tax strategy, this is my investment strategy, this is my retirement portfolio. It's still the same bucket. So what we do here is, oh, it's December 2025. You know what? I'm going to go ahead and harvest all my tax losses because IRS says, look, if you get rid of your stocks and you have a loss, you can take it off, right? You should not be buying the same stocks or similar stocks within 30 days. It's called the wash rule, 30-day wash rule. So what that does is investors will quickly harvest their tax losses in December, turn around and buy after the 30-day mark, they will buy the stocks again, small cap stocks, in January. Because now they are avoiding that tax IRS rule that I was talking about. Mental accounting, again, separates tax strategy from investment strategy. What people do not realize, it's the same bucket. It's the same amount of money that is associated with you and I. So it creates a very demanding, very predictable pattern. Behavioral finance and portfolio diversification. Here, you see the different buckets, and what folks are doing are saying that, look, I think I'm going to have a college fund for my kid, and I'm going to have a retirement 401k account at JCC. In my college fund, I will have technical stock, hold stocks in technology companies, and what that will do is I can take a little risk there and get money faster, but in my 401k account, I will actually go ahead and keep more conservative funds or conservative stocks. The fact of the matter is, the correlation and these types of buckets can still leave you overweighted in, let's say, the growth stock strategy. You're not thinking along, you're thinking along the lines of buckets. You're not thinking along the lines of one big portfolio. Here, I want to talk about the home bias. There's a lot of good money. Folks are saying, I am sticking with United States. I'm not looking at the Japan Nikkei stock index. I'm not looking at the London stock index. Right now, home country of Pakistan, stock market is just going gangbusters. Why do I not feel comfortable investing in global stocks? Well, maybe people are leery of thinking about the rules and regulations overseas. And then what that does is it overweights them into domestic stocks, domestic funds, and especially if there are employer-sponsored stock options. There, they don't realize that majority of their portfolio is actually within a certain company or a certain sector, or within, of course, within the US territory, if you will. the diversification that takes place in our 401k portfolios is also interesting. And I've seen this, I think, through the years with my colleagues when I talk to them, that they go down the list of what, let's say, JCC has to offer within TIA CREF, and they say, if I put 20%, 20%, 20%, I've pretty much diversified my portfolio because I've taken, everybody tells you to have diversification. Well, diversification still will leave you very exposed, because what happens is that, again, let's think in terms of the entire portfolio. You may have a lot of high-risk stocks which are found in these different classifications that you did not consider. And as a result, when the economy starts to go up and down, there is a correlation in these different funds, in these different stocks and securities. So there's a false sense of safety, I believe, if you think you are diversified 20% in each area, if you will. So what happens is correlation starts to break down, and we saw it in 2008 crisis. Stocks, real estate, commodities, everything tanked. One would have said, well, I would have been better off in thus and such, but we saw that there was a strong correlation in all of those sectors, which started to break down. So we see these rebalancing failures, which basically are giving you some sort of a false security, but you need to really check your own biases, that have you really basically done these types of rebalancing, thinking that you are diversified because you took 1 times n, again, dividing it equally in all your different categories. So last, I want to talk about the AI impact. What is that doing to the world of investment? AI is telling us that, look, a large part of what we are seeing in terms of emotional and cognitive biases, that is going to be taken care of, because now machines are talking to each other. There is no human or personal biases involved. So you have robo-advisors, which, by the way, are very popular with the younger crowd. 20, 25, 30, but not with the traditional retail investors who are of a certain age. So yes, the tax loss harvesting that I was talking about, the disposition effect, that I'm going to hang on to my losers so that I can go ahead and eventually see my stocks come up, all of that is being mitigated by AI, which is the good news. So what is the bad news, or what else should I consider in terms of behavioral rebalancing? True rebalancing would say that I should have taken a better look at the correlation between the different portfolios, which is what Markowitz was talking about, but I did not immediately harvest or look into selling the losers very long or quickly, because I had emotional attachments that I could not have been dumb enough to make that decision. So why would AI not completely get rid of these behavioral effects, in my estimation? Well, my 2 cents worth of clinical psych and my knowledge of human behavior tells me that machines are being programmed by humans, correct? So if that is the case, those biases will creep into AI models as well, and we'll never get rid of them. Having said that, I also think that not all market participants, I would rely completely on robo-advisors. God has given me something that is much better than any machine. And so I would feel confident if I had some say-so in my decision, my investment decisions. So I personally see more of a hybrid model coming into vogue. Now, interestingly, I also want to caution you that new anomalies are taking place because of AI. And what are those new anomalies? I can give you an example. through GameStop. How many of you are familiar with GameStop phenomena? And do you know what exactly happened? Well, let me tell you how the AI algorithms started to talk to each other. GameStop was a fledgling video gaming company. Hedge fund managers in New York, they are sitting there, they are thinking, well, we'll short the stock. What is shorting the stock? Well, it's a very common financial strategy. I'm going to call my broker, tell him I want to short 10 stocks of GameStop. And the broker says, here are 10 stocks at $10, and it's now priced at $10 a stock. I wait. I'm betting that the price will go south. I will wait until the price comes down to $5. That's when my transaction is complete. I buy the stock for $5. I replace it. I easily made $5 on that stock. That's how shorting works. So in the case of GameStop, these hedge fund managers, they said, let's go ahead and short the stock because it's a fledgling company. Well, the word got out on social media, so especially on Reddit, where there is a community of investors, and they basically got a hold of that, and they said, collectively, we will give these hedge fund managers a run for their money. They started to shore up the price collectively, and the GameStop stock went all the way to what, $400? Now imagine if you're the hedge fund manager, you're getting nervous that, oh my God, there's a short squeeze here. What do I do if the stock keeps climbing further? To the point that Robinhood stopped trading that stock. They wouldn't allow it. And of course, these retail investors then talked to Congress and said, how could this be that I was prevented from on that trading platform? But nonetheless, how do you think this was happening in the background? This was happening because of algorithms talking to each other. So now, in the age of AI, the concern is that if these algorithms talk to each other and there's an algorithm sentiment, it can send signals so rapidly that we can see gains and drops within no time at all. And you and I are wondering, I know there's no human bias, but as soon as a signal is triggered, these algorithms and the AI phenomena gets into action, and next thing you know, you see a lot of millions of dollars getting wiped out or gained artificially. So I believe the hybrid future is the way to go. And just like education, I hope I'm never replaced by an AI model. I think the investing future is also in a large part of the January effect that I was talking about, the Monday phenomena, calendar-based anomalies, some of the emotional triggers that I was talking about earlier has been mitigated. I'd be lying if I said they haven't by this AI phenomena. But I think it needs to be studied further. My point here is that behavioral finance is very much alive in the background. You and I are subject to it. And if we start to look at how this current phenomena of machines talking to each other within milliseconds is creating new anomalies that we hadn't even thought of. All right, so I think my point in selecting this topic today was for you to be recognizing your own biases based on your emotions, based on your cognition, looking at how you are rebalancing or balancing your portfolios, and recognizing that you may be not looking at your entire portfolio and the stocks therein to start recognizing the correlation in your assets. And obviously, I think it is important to understand that we should remain cautious during these turbulent times, especially within the political environment. And Lastly, if you want to go ahead and read further, I would suggest start there. There's a lot more information, of course, that you will find. And now, in the remaining time, I'll take any questions or comments you may have.
Thank you for the wonderful information. Does it apply also to cryptocurrency?
I would say so, because Bitcoin has experienced the same phenomena.
I wondered
In
if they were
2017.
parallel to each other, the same
Yes.
behavioral.
In 2017, they had a huge psychological effect, and then it crashed, and then it rebounded. So that's an excellent question. Anything else that that you would like for me to clarify? Or any other comment?
I'm curious why GameStop is considered you call it a fledgling stock. I know it's a bit older, but is it still considered like a newer stock? Is that why it's called a fledgling?
I think streaming had become more popular, if you will, so therefore the attractiveness of a brick and mortar video gaming was not very popular. And I think that phenomena was not considered on the streaming side of it. And as a result, the hedge fund managers thought they would jump on that. Any other questions, comments? Yes, Anome?
Great job, Professor Hussein. So I had a question about the AI element. So you stated that AI would not completely replace the behavioral elements of would not replace the behavioral side of it. But the CEO of, I think it's Chase, I think his name is Jamie, Mr. Jamie, I forgot his full name. He made a comment at a finance conference within the last 3 months that essentially like 30% to 50% of their jobs will be replaced. So why do you feel as if the AI would not actually, even though you still need that human interpretation, that it would not still replace maybe the majority of those positions?
So that's an excellent question, that if the finance CEOs are telling us that these entry-level jobs and other positions are going to be replaced through AI, I just attended a seminar based on that same topic, and I'm about to introduce in my financial classes the AI element and automation to go ahead and give a little sense of sensitivity to my introductory students even on the entire fintech industry, if you will. My question is not about whether or not the human element of trade. So yesterday, I just called Merrill Edge, my investment account, and I told them, hey, guys, you've blocked me from options trading. Why is that? And this has been going on for months. The human element there is that they told me there was a fraud investigation on my account, and therefore they had blocked me. Now, those checks and balances, if I had been dealing with a robo-advisor, that would have gone through, but now they are investigating, and they are going to go ahead and see where automatically some sort of an AI element must have crept in, some kind of a stock trading that I may have done that would have triggered it. AI needs to be managed. It hallucinates at times. And so I think those people in the industry are not incorrect. They are looking further down the line, because the jobs I see in just about every field, insurance, accounting, investments, they are talking about AI enhanced jobs, but they are not talking about complete replacements. So I think the truth is somewhere in the middle right now. We will never be, the entry level, the automated type of things where trades take place, I can do it on E-Trade, I can do it on Merrill Edge, anywhere. Those are instant. But that investment strategy, that investment portfolio that we are constructing, that requires a human intervention to some extent. And especially, not everybody is going to be in the AI. I mean, how many of us here feel comfortable dealing with a online bank? I can guarantee you, you do. That's great. On a CD, you're going to get 4.5% right now at SoFi, as an example. But Bank of America is not going to give you more than 3.5 at the most for a CD. Why don't money people then gravitate towards a SoFi or online bank? Because they are not really in tune with like an online. We like to think that there is a brick and mortar. As demographic changes take place in the United States and across the globe, I think that we will start to see maybe more of the AI, but not in the near future, is what my guess is. Well, I can't thank you enough for encouraging me and being here and spending your precious time with me and listening to anything that I may have said that added to your information, but I certainly appreciate each of you. Thank you.